You're looking at a 1099 form right now. Maybe from DoorDash, maybe from a client, maybe from a platform you barely used for 3 months. And there's a number on it, your gross income. And somewhere in the back of your mind, you're already doing rough math, and the result is making you uncomfortable. So here's what I need you to know before we go any further. That number on your 1099 is not what you owe. It is not even close to what you owe. And by the end of this video, you are going to know the exact calculation, your specific number, and exactly what to do with it. Let's get into it. First, let's understand what just happened to you. There are two kinds of workers in the American tax system, and they live in two completely different worlds. If you have a W-2 job, your employer takes taxes out of every single paycheck before the money ever reaches you. Social Security, Medicare, federal income tax, all withheld automatically. You never see it. You never think about it. But when you earn 1099 income, none of that happens. DoorDash doesn't withhold taxes. Uber doesn't withhold taxes. Your freelance clients don't withhold taxes. Every dollar you earned arrived in your bank account as pre-tax income, which feels great all year long. More money hitting your account. But it creates a responsibility that nobody explained to you. Because that tax money, the part your employer would normally handle, is still owed. It's just owed by you now, and it's due later. Now, the form itself, you probably got one of two types. A 1099 NEC, which stands for non-employee compensation. That's what you get from clients and platforms that pay you directly for work. Or a 1099K, which comes from payment processors, like PayPal, or the platforms that handle transactions, like Etsy or eBay. The difference matters for some situations, and we'll cover that in detail in another video. But for right now, understand this. Both of them mean the same fundamental thing. The IRS received a copy of this form too. They know what you earned, which means this income has to go on your tax return. Okay, back to that number on your form. Let's say it's $41,200. That's your gross income. And here is the single most important thing in this entire video. You do not pay taxes on $41,200. You pay taxes on what's left after your business expenses, after your deductions, after the adjustments the tax code gives you. The number you actually get taxed on is almost always significantly smaller. Think of it like a funnel. Your gross income goes in the top, then it passes through your business expenses, your self-employment tax deduction, and any other deductions you qualify for. And what comes out the bottom, that's the number the IRS actually taxes. For a lot of gig workers, that final number is 20, 30, sometimes 40% smaller than what's printed on their 1099. And this is exactly where most people make their first expensive mistake. They see $41,200 on their form, they panic, they assume they owe taxes on the whole thing, and either they overpay or they get so overwhelmed they don't file correctly at all. Neither of those things needs to happen to you. Now, here's something that surprises almost every first-time 1099 earner. As a self-employed person, you actually pay 2 different taxes. Not 1, 2. And understanding the difference is the key to understanding your whole bill. The first one is called self-employment tax, and it's a flat 15.3% of your net earnings. This one trips everybody up because W-2 employees never see it directly. Here's what it actually is. It's Social Security and Medicare. 12.4% goes to Social Security, 2.9% goes to Medicare. When you have a W-2 job, your employer pays half of this for you, and you pay the other half, and you barely notice. But when you're self-employed, you are both the employer and the employee, so you pay both halves. That's why it feels like so much, because you're covering the part your old boss used to cover. So on our example, $28,400 of net earnings, the self-employment tax comes to about $4,345. That's the first tax. The second tax is regular federal income tax. This is the one you've heard about your whole life. It works on brackets. The more you make, the higher the rate on each additional dollar. But here's the good news for our example earner. Before income tax is even calculated, you get to subtract the standard deduction. For a single filer, that's $14,600. And remember, you also get to deduct half of that self-employment tax you just paid. So your income that's actually subject to income tax drops even further. When you put it together for our example, roughly $4,345 in self-employment tax, plus a few hundred to maybe $1,100 in income tax after deductions, and you're looking at a total tax bill in the range of $5,400, not $41,200, not anywhere near it. That's the difference between the scary number on your form and your real number. Now let's talk about the part that actually puts money back in your pocket. Deductions. Every legitimate business expense you have reduces your net income, which reduces both of your taxes. And most gig workers leave a fortune in deductions on the table simply because nobody ever told them what counts. Number one, and this is the biggest one for most drivers, mileage. If you drive for DoorDash, Uber, Instacart, any platform that involves your car, the IRS lets you deduct a set amount for every business mile you drive. And that rate is around 70 cents per mile. Let that sink in. If you drove 15,000 business miles last year, that's a $10,500 deduction. $10,500 coming straight off your taxable income. If you didn't track your miles, you just lost a huge chunk of that. This is the single most important habit for any driver. Track every mile from the first day. Then there are the others. The business use portion of your phone, because you can't dash or drive or freelance without it. A home office, if you have a dedicated space where you manage your work. Supplies, the insulated bags, the equipment, the tools of your trade. The business portion of your internet. These add up faster than you'd expect. And here's one the IRS just gives you. Remember that self-employment tax, the $4,345? You get to deduct half of it automatically. No receipts, no tracking. Your tax software does it for you. That's another roughly $2,170 off your income just for existing as a self-employed person. And then there's one almost nobody claims correctly, the qualified business income deduction. For most self-employed workers, it lets you deduct up to 20% of your qualified business income on top of everything else. We have a whole video on this one because it's that valuable and that misunderstood. Now, there's one more thing you need to understand, and it's the thing that catches people off guard more than anything else. The IRS doesn't want its money once a year. For self-employed people, it wants it 4 times a year. These are called quarterly estimated taxes, and the deadlines are April 15th, June 15th, September 15th, and January 15th of the following year. Because no employer is withholding tax from your pay, the IRS expects you to send in estimated payments throughout the year as you earn. If you skip them and just wait until April to pay everything at once, you can get hit with an underpayment penalty. It's not catastrophic, it's calculated like interest on what you should have paid, but it's completely avoidable, and avoidable costs are the ones that hurt the most. And here's the good news. There's a simple way to never owe a penalty. It's called the safe harbor rule. If you pay, in 4 equal installments, 100% of what you owed in taxes last year, the IRS can't charge you an underpayment penalty, no matter how much you make this year. It's the simplest, safest way to handle quarterly taxes, and we have a complete walkthrough of it on the channel. And if all of this still feels like a lot, here's the one habit that solves most of it. Every time you get paid, set aside 25 to 30% in a separate account. Don't touch it. That's your tax money. When the quarterly deadline comes, it's already there, waiting. This one habit turns tax season from a panic into a non-event. Okay, let's turn everything we just covered into exactly what you do next. 5 steps, starting today. Step 1. Gather every 1099 you received. NEC, K, all of them. If you worked multiple platforms, you have multiple forms. You need all of them. Step 2. Add up your deductible expenses. Your mileage first. That's usually the big one. Then your phone, supplies, any equipment, any business costs. If you didn't track them this year, start tracking them right now for next year. Every receipt is money back. Step 3. Subtract your expenses from your gross income. That gives you your net. And your net is what your taxes are actually based on. This is your real number, the one that matters. Step 4. File using software built for self-employed people, or work with a tax professional if your situation is more complex. The right tool asks you the right questions and catches the deductions you'd otherwise miss. I'll leave my recommendation in the description. It's what I'd use for this exact situation. And step 5, set up your system for next year. Open that separate tax savings account. Set aside 25 to 30% of every payment. Mark the 4 quarterly deadlines in your calendar. Do this once, and you never face a tax season surprise again. That's it. That's the whole thing. The 1099 that made your stomach drop a few minutes ago is now just a number you understand. You know what it means, you know what you actually owe, you know what you can deduct, and you know exactly what to do. Now, this was the foundation, the big picture. But every single thing I mentioned today, the mileage deduction, the QBI, the safe harbor method, the platform-specific guides, each one has its own complete breakdown right here on the channel. So if this is the channel you've been looking for, the one that finally explains this stuff in plain language with real numbers, subscribe, because every video here builds on what you just learned. Your tax situation is about to get a lot clearer. I'm glad you're here. I'll see you in the next one.